The topic today is how to make money from investing in stocks. Investing in stocks is one of the most effective methods to grow your financial future. However, many people either avoid it or fear it because they do not fully understand how it works. This video will help you understand stock investing step by step. You will learn how to start, what strategies to use, and how to minimize risks. Stay with us until the end because every point we cover can make a difference in your journey. Before we start, make sure you like this video and subscribe to the channel for more financial knowledge. Your support motivates us to create more helpful content. Now, let's dive into how you can make money from investing in stocks. Apart from price growth, some companies also pay dividends. Dividends are small cash payments given to shareholders from company profits. This means you can earn money from both price increases and dividend payouts. Understanding these basics is the foundation of stock investing. Why invest in stocks? Stocks historically have given higher returns compared to other investments. For example, over the long run, the stock market has grown at an average annual rate of 7 to 10%. This is higher than savings accounts, bonds, or fixed deposits. By investing in stocks, your money works for you and grows over time. Another reason to invest in stocks is the power of compounding. When your earnings are reinvested, they start generating more earnings. This snowball effect allows wealth to build steadily over the years. Stocks also provide ownership in real businesses, which grow as economies expand. Long-term versus short-term investing. One important decision is whether you invest for the long-term or short-term. Long-term investing means holding stocks for years or even decades. This approach takes advantage of market growth over time. Short-term investing focuses on quick trades, aiming for fast profits. While short-term trades can be profitable, they also involve higher risks. Long-term investing, on the other hand, reduces risks caused by short-term market fluctuations. History shows that long-term investors usually outperform short-term traders. Patience is often rewarded in the stock market. How to start investing in stocks? The first step is to open a brokerage account. A brokerage account is an online platform that allows you to buy and sell stocks. You can choose between traditional brokers or online trading apps. When selecting a broker, check for low fees, easy-to-use platforms, and educational resources. Do not just buy a stock because someone recommended it. Instead, look into the company's financial health, revenue growth, and market position. Study the industry trends and competitive environment. Check if the company is profitable and has low debt. Also, read annual reports and analyst reviews to understand future potential. The more informed you are, the better your chances of success. Research helps you invest in strong companies rather than speculating blindly. Diversification means spreading your investments across different industries and sectors. This reduces the risk of losing money if one stock performs poorly. For example, if you invest in technology, healthcare, finance, and energy, your portfolio is safer. Diversification balances your risks and rewards effectively. It ensures that a setback in one area does not destroy your entire portfolio. Examples include global giants in technology, banking, or consumer goods. Growth stocks, on the other hand, are companies that reinvest profits to expand rapidly. They usually do not pay dividends but can increase in value significantly over time. Investors often combine both blue chip and growth stocks for balance. Blue chips provide stability, while growth stocks provide higher potential returns. Knowing the difference helps you build a balanced portfolio. Value investing strategy. Value investing is about finding undervalued stocks. These are companies whose prices are lower than their true worth. Investors like Warren Buffett have made fortunes using this strategy. The key is to identify solid companies trading at a discount. Value investing requires patience and discipline but can yield great results. It is suitable for investors who focus on long-term growth. Growth investing strategy. Growth investing targets companies with strong future potential. These companies usually show high earnings growth and innovation. They often belong to industries like technology, healthcare, or green energy. Investors buy them expecting that they will expand rapidly. Growth investing carries more risk but can generate higher returns. The strategy works well when the economy is expanding. However, during downturns, growth stocks may be more volatile. Balancing growth investing with other strategies helps manage risks. Dividend investing strategy. Dividend investing focuses on companies that regularly pay dividends. This approach is popular with investors who want passive income. Some investors build portfolios entirely from dividend stocks. This creates a reliable stream of income while still benefiting from stock price growth. Dividend investing is ideal for those seeking income and long-term stability. Index funds and ETFs. Not everyone wants to pick individual stocks. If you want a simpler approach, index funds and ETFs are great options. Index funds track the performance of an entire market index, like the S&P 500. ETFs, or exchange-traded funds, are similar but trade like stocks. Both allow you to invest in many companies at once, providing instant diversification. They have lower fees compared to actively managed funds. They are suitable for beginners who want easy exposure to the stock market. Many investors use index funds for long-term wealth building. Risk management in stock investing. Every investment carries risks. Stock prices can go up and down due to market conditions. The key is to manage risks wisely. Discipline and patience are the strongest tools of successful investors. The importance of patience. The stock market rewards patience. It is normal for stocks to go through ups and downs. Many beginners panic and sell when prices drop. However, history shows that markets recover over time. Patience often separates successful investors from unsuccessful ones. Avoiding common mistakes. Many investors lose money because of common mistakes. One mistake is chasing hot tips without doing research. Another mistake is investing emotionally rather than logically. Some invest too much in one company, ignoring diversification. Others panic during downturns and sell at a loss. Timing the market is another common mistake. Even experts struggle to predict short-term movements. Avoid these errors by sticking to a clear strategy. The role of continuous learning. The stock market keeps changing. New industries emerge, and old ones decline. To stay ahead, you must keep learning. Read books, follow financial news, and watch educational videos. Study successful investors and understand their strategies. The more you learn, the better your investment decisions will be. Knowledge is a powerful tool in building wealth. Continuous learning ensures you adapt to market changes. Conclusion. Investing in stocks is one of the best ways to grow wealth. It offers higher returns compared to many other investments. With the right knowledge and strategies, anyone can succeed in the stock market. Start small, diversify your investments, and stay patient. Focus on long-term growth rather than short-term gains. Remember that risk management is as important as earning profits. Avoid common mistakes and keep educating yourself regularly. This way, you can make money from investing in stocks effectively. Outro. Thank you for watching this video on how to make money from investing in stocks. I hope you found it valuable and informative for your financial journey. If you enjoyed the content, please like this video to support the channel. Do not forget to subscribe so you never miss future updates. Your support helps us keep creating more helpful videos. Stay consistent with your learning and investing efforts.